Hello, everyone, and welcome back to another episode of Stance on Finance. Today, we have with us here a very special guest, Rohit Krishna. He's a chartered accountant who's cleared all three levels of his CFA. He started out his career with Moody's as a research analyst, moved on to Spark Capital Advisors to continue his research work, and then joined WEH Ventures. And today, he is with us here in the capacity of a general partner. So we're very excited to have you today. Can you let our listeners know a little more about yourself and
Thanks a
what
lot
you're
for
currently
having me.
doing?
And I think I've wanted to be in the investment field. I think that's the one thing I knew for a very long time. So I was trying to figure out paths sort of to get there, and also just within investments understand what I really like, and finally found that at WH Ventures, and that's sort of why I've stuck around. But we can speak more about it. I'm sure you'll have questions, so we can speak.
So to kick things off, could you tell us what the entry path to your career was like and what an average day for you in general looks like?
Entry path is ideally two ways. One, you work at a startup, a young or a growth stage startup, and you get connected to VCs, and then you get a flair for probably trying to be a venture capitalist yourself. That is one path. The other path is more related to investments, where you ideally work at a different asset class, could be a public markets at a mutual fund or sell side, uh, doing research, and that's another way to get into VC. Ideally, you'll have to love one of two things, either be really in love with investments or really in love with startups.
Right.
I think this is the perfect way to do it, and some people have both, which is rare, but even one is good enough. And ideal day, see, we look for companies at the very very early stage, so most of our time goes in either speaking to founders or sourcing founders, like could be online or could be connecting with people offline and then getting referrals to people they know who is starting up. And the other part of it is actually working with existing portfolio companies. So we go meet them and then sort of figure out. So the day is usually split across speaking to new founders and our existing portfolio.
Okay. So in WEH, like how is your company structured? Like how is the fund structured? How do you decide your management fee and things like that? What exactly is the business model of WEH per se?
Yeah, see, basically we have two entities. One is the WH Ventures Trust, which is where the investments go, and then whenever we exit a company, the money comes back there. And in this WH Ventures Trust, we have investors who put in money. We've also put some of our own capital there, and this is a pooled capital vehicle. And then we have a LLP, or it could be a private limited company also, where all the employees are and all the partners are sort of paid from
Working,
as
okay.
well. So the WH Ventures Trust pays a management fee on a yearly basis to the LLP, and then the LLP in turn sort of manages the operating expenses of the fund. And how it works is usually the management fee is not like, I mean, there's not a lot of negotiation there, because it's an unsaid sort of rule that it's 2% per year,
Okay.
and then 20%
It's
as
your carrying
carry.
interest.
Yeah, which is basically your profit over and above the hurdle whenever you exit a company.
Okay.
And so it's the 220 rule is fairly common.
All right.
So you have any other questions?
No. Go ahead.
So the VC space is a great example of the Pareto principle. Yeah. So could you shed light on what a successful investment versus an unsuccessful investment, like your judging process would be, and what due diligence you'd follow to ascertain which is what?
Sure. Yeah, see, you learn a lot, right? Like while after you make an investment, when you make an investment, you expect everything to be successful. Even though you know, you've read about the Pareto principle, it's very, very hard to believe that 90% of the companies that you invest will probably shut down.
Right.
But that's sort of what happens. So you learn it over a period of few years when you invest, and then you work with the founder, and then it either works out or it doesn't work out. When it doesn't work out, you take back a lot of sort of learnings as to why it did not work out. There are obviously multiple reasons why. I can give you examples of things which did not work out first, probably. There was a company where we invested at the pre-product stage. It was a fintech sort of product. but due to regulatory reasons, they could never launch the product.
Okay.
So they returned the capital. They realized that there was no way, there's no loophole they could use to sort of launch it. So if you can't launch it, there's no point.
Right.
Yes, you could do a hard pivot and do something else, but the founders did not want to do that. The second is when, let's say, there's no founder market fit. Meaning the founders are, let's say, really good at building B2B products, B2B sales and enterprise sort of things, but then they're building a consumer product.
Right.
For whatever reason. They, like now, while coming up, I saw some things on AI, etc. Right? So that is a trend. So people try to follow the trend, irrespective of whether they're good at it or not.
Right.
And sometimes we are able to identify what the founders are good at, but usually, we decide within 3 to 4 meetings.
Okay.
So sometimes we get it right, sometimes we get it wrong. But if that founder market fit is not there, most probably the company will probably not be a big hit. It could have a small M&A, etc., or it might shut down. So these are reasons why it doesn't work out, and these are my learnings over whatever few years.
Can you tell us about some of your successful picks?
Yeah,
so far?
successful. Yeah, successful small case I think is a big success for us.
Right.
And
So what was your thought process when Small Case approached you?
Yeah.
Like, when did you decide, okay, this is this is a good one?
Sure. Small case did not approach us. We
You
approached.
approached,
Yeah.
okay,
We
alright.
reached out to the founder after looking at the app. I really liked the app personally, and I was like, okay, this is different than what was there in the market at that time, because everything else was about investing in a mutual fund. And to be honest, it's very hard to understand which mutual fund will work.
Okay.
You can't say because it's the asset manager picking, and you can just look at past results, but past results is not necessarily indicator of future results, right? Like, so it doesn't work. But Small Case was doing something very different. It was almost mimicking a mutual fund, but at a smaller scale. So we knew the product was unique, so that's what was attracted us. So we spoke to the founder. But the founding team was amazing. Like all the 3 founders, they had like completely complementary skills, and they're friends from IIT Kharagpur. So Vasant was very, very happy leading the CEO role, and then there's Anugraha who was doing the research on the investment side, and then there was Rohan who was a CTO. So they were like very, very complementary skills. And so Small Case, within the first call, I was really impressed. So we needed to want to invest. Then Deepak had another chat with them. So within 2 calls, we knew we wanted to invest. So within about 10 days or 7 days, we issued a term sheet. And I'll tell you the reason why a lot of VCs passed on Small Case when we evaluated it was they felt like that the market size was probably not good enough to have a very, very large exit. Because at that time, the only partnership they had was Zerodha. Now they're connected to obviously all brokers, but that time it was only Zerodha, and the audience was expected to be very, very niche and not grow. But we thought this is an interesting product, and they built this product with almost very, very less capital. And the users who like this product are obviously very sticky. So we thought this,
you'd want to use the product because it's that easy to use, the user
Exactly.
interface and things.
Yeah. And so we thought this audience who like this kind of a product will grow over a period of time. And also there is a possibility that Small Case could launch a mutual fund, which is a more mainstream kind of product, which is what they've done. It took them about 7 years to get there, but eventually they did launch a mutual fund along with Zerodha. It's a 50-50 kind of partnership. And so that was our thesis, and that's why we believed in it early, and it sort of played out in every possible way in the right sense.
So you said you evaluated it on metrics that maybe your other competitor venture capitalists passed it off of.
Yeah.
So could you tell our viewers what exactly that due diligence process looked like when it came to evaluating what the potential for Small Case was?
Sure. See, at the early stage when you're doing, let's say, a seed round or a Series A round, there are 2 things basically you look at. One is, like I mentioned, the founder market fit. Like how good is the founding team, which is usually very, very qualitative, and you get better at it only over a period of time. There's no perfect answer. There is no teaching that can be passed on. You just have to speak to hundreds and hundreds of founders to understand, okay, who could be good at doing what
Okay.
in which sector.
Sir, these founders, right? It's a thing that if you're from IITs and the top
Yeah.
B schools, you automatically have a lot of credit to you. Is that something that you've noticed? Because the Omega reports that came out
Yeah.
from Bloom Ventures, they mentioned that a large chunk of their successful investments had top IITs and IIM guys on the top.
Sure.
Is that something you've noticed as well?
No, I disagree with that. I know that they feel that a lot of success comes from pedigree as well. But if you see our website, we actually believe in the opposite. We do not have a preconceived notion when we speak to someone like this sitting opposite to us. We don't necessarily care where they've studied or what they've done before. As long as they have a lot of passion and also capabilities to be building what they're supposed to be building. I think that's sort of what is important. If in our portfolio we've done this math, I think 60-70% of our portfolio founders, we don't even look at education as much. I think what we've tried to see is whether they've had a lot of success in another startup.
Okay.
And most of them don't have. They usually, like the path that I told you about, the VC analyst kind of space is the same path to a founder also, like where you work in another startup for 3-4 years after your undergrad or postgrad, and then you immediately start up. So usually our founders are between 25 to 28
Okay.
age group when they start up, and including small case.
Okay.
They did not have a lot of past success. Yes, they are from IIT, and some of them are not from IITs, but it doesn't
Doesn't matter.
necessarily
It's just an
matter.
added benefit.
Yeah.
So you guys enter. So WH is a fund that usually specializes in pre-seed and seed.
Yes.
So what happens after that? What happens after you raise your 2 rounds and post that? What happens? How
Yeah.
does it look like?
See, with pre-seed and seed, what you're doing with the capital is you're trying to build a product.
Yeah.
And sometimes you get early signs that the product is working in terms of customer traction and also in terms of making money, revenue. And sometimes it doesn't work out. So if it doesn't work out, you have to reiterate the product, speak to customers, understand why it's not working out. And you might come to a conclusion that probably the market that you're going after, the product that you're going after, there is no need for it. Then you have to do a hard pivot, do something else altogether, or shut down the company and return the capital. These are the two paths. Once you have early signs of PMF in terms of traction, then you go ahead and raise a Series A. And with Series A, you get more revenue, probably build on your unit economics and get to a lower sort of negative EBITDA.
Okay.
And then you raise a Series B
Right.
to probably lead to a path of profitability. This is the ideal sort of.
Right.
So from an analyst standpoint,
Yeah.
where there are no numbers essentially at this stage,
Yeah.
where the seeds fund taking off, what metrics would you recommend?
Because you usually just see ideas and like a PPT.
Yeah.
There are no Excel sheets, nothing to judge the company on. So what
So
do
when
you
you're
look at?
basing a fund off of that, what kind of concrete, tangible proof do you give yourself or your management?
Yeah. So like I was saying, one is the founder side, which is very qualitative.
Right.
There are no numbers. The
Qualitative.
second is actually the market and the product, etc. For example, small case, when we met them, the product was there, customers were using it. So we could see metrics like retention of existing customers on the product.
Okay.
What was the CAC for getting that customer in the first place? Things like this. Giving another example, let's say it's a D2C brand.
Right.
Both 2-3 brands that we've invested in, we've come in at a stage when they were doing about 3 to 5 lakhs a month in terms of revenue.
Okay.
So there was a product, they were selling it mostly through online and their own website, but 5 lakhs is nothing. Like I'm sure in Christ also there'll be a lot of hustlers who have
Yeah.
other products
Yeah.
and they're selling 5 lakhs. But the point is to understand how much can this 5 lakhs sort of scale? Is there a possibility to get to a 2-3 crore kind of a monthly revenue mark? At that point you can raise a Series A
Right.
or a largest sort of Series A. So what metrics we look at then is, let's say ROAS, like return on your advertising spend. Like how much are you spending to get this 5 lakhs revenue?
Right.
Usually it should be, let's say, north of 6-7x
Okay.
at that stage, because that indicates that there is a real need for the product and customers are looking for it. And probably once they buy it, there is strong word of mouth which is lead to other people buying the product, and that's why your ROAS is very high. If let's say the ROAS is only 2x at that stage, that means that you're relying a lot on performance marketing to push the product.
Nobody's really wanting the product.
Yeah.
No.
Yeah. So things like this, and there are metrics. It's just that the metrics are different for different kind of company. Let's say if you're looking at a robotics company which we invested in called Unbox Robotics, the only metrics that we could see was results from their pilot customers who they were piloting the early product to, like what were the efficiency metrics of the robot that they were looking for and whether it was hitting it or not.
So the KPIs are basically pre-market in
Correct.
such cases.
Correct. Those are pre-market, but yeah, they're very different.
So there's no one right way to do it.
Yeah,
Just
there is
look at
no
it
one.
from all angles.
Yeah, but that's why you also get, let's say, good at certain sectors as a person, not necessarily even as a fund. Like you, once you look at a lot of companies in a certain sectors, let's say you get better at evaluating DTC brands
Okay.
versus someone else. And it's actually very easy to pass on a company when they're at this stage, doing 3-5 lakhs revenue a month. But it's about going beyond that and seeing what someone else is not seeing. I think that's what gives you the edge, and that's what gives you the alpha of finding and backing a company. Like we invested in a company called Master Cha very early on, again 5 lakhs. Now they're doing really well.
Yeah.
And it's not like, so the edge is actually not speaking to someone that others cannot speak to.
Right.
It's about also choosing and investing in that company.
Okay. That's a nice answer.
Yeah.
Sir, another question that I really liked is Peter Thiel's Contrarian Truth,
Yeah.
where he speaks about those some stuff that he agrees on and nobody usually agrees with him on.
Sure.
So is there anything that you feel you have something like?
Yeah, I mean, sure. There are more than one, and one which I mentioned already is on the pedigree of the founder. We strongly believe that pedigree does not matter. It's more about passion and your previous experience, and also your capability matching with what market you're going after. I think that is one. The second is, I think smaller is better in terms of funds. I think there are obviously a lot of large funds that you keep hearing about and raising larger funds. But we believe at this point in the Indian market where multi-billion-dollar IPOs are not necessarily happening every day, it's not that common. It's easier to return like a sub $100 million or sub $50 million fund, like giving the IRRs that LPs expect, rather than a very large fund expecting very large outcomes like over 10 billion kind of outcomes, which are not that easy to come by. So that's why we've also consciously remained smaller and stayed in the same pre-seed and seed sort of stage.
So bigger doesn't necessarily mean better. Is
Yeah.
what you're saying.
Yeah. Like if you look at private equity, for example, bigger does mean better, because that heft gives you easy capital to go after larger sort of deals.
Right.
Whereas it's completely the opposite in my view on the VC side. More money doesn't mean better anything.
Okay. All right.
Yeah.
So the room for failure in a larger VC fund would just be higher.
Yeah, because the expectations are higher, both from a founder. Let's say you back a founder, they have to perform 10x more to give you
To
a
satisfy
decent
all your
exit.
investors as well.
Yeah.
So another thing is people say stay bootstrapped for as long as possible.
Yeah.
As a person from the VC industry, what do you think?
See, I don't know. There are obviously great examples like Noise, which was recently in the news, or
Especially for the Indian market, where
Yeah.
Traditionally we just believe on just taking out a loan or using your family funds, friends, and these type of funds than to go for external funding.
Yeah.
So in that space, what do you think is your?
See, for example, you can do that for certain sectors you can't. For brands, you definitely can do that. There is no need for money. Like I think the only reason why you'll need money is for inventory, which you can get multiple forms of capital like debt, etc. But let's say you're building a social product. There's no chance you can be bootstrapped.
Where you need to have that presence in the market.
And you need to really have explosive growth early on for the product to even work.
Okay.
Or let's say you're building even something like a small case. It's not possible to be bootstrapped at this stage because you have a lot of competition. There is a cost of acquiring the customer, and the LTV doesn't come immediately. When you're selling a product, you're making money immediately,
There,
right?
then and there.
And it's usually profitable, hopefully. But it's not the same for fintechs, so many fintechs. Or if you are a lending company, you need money to lend.
Right.
So there is equity capital that you have to raise. There is no other choice. So for a lot of sectors, there is a bootstrap sort of is not a possibility. Bootstrapping is not a possibility at all. So you will have to raise your seed round and then Series A and then follow the venture path.
Makes sense.
So coming to WEH, it focuses on stuff like small case to, like you said, a robotics company. So what's the next big industry, do you think, from a perspective of
Yeah, especially
booming?
because major investments of WH is in the tech space.
Yeah.
Do you think
Is that the new
where-
big thing, or do you
Yeah.
think there's another big industry that's ready to, boom?
See, I think the way we look at it is like a barbell kind of an approach,
Okay.
where on one hand we invest in consumer brands. I think India is still a brand-starved country. There is,
Right.
if you go to the supermarket aisle in Australia or US versus India, you'll just see so many more brands for every category. We are not yet there, but there is still aspirations, and people do want different things. So on the brands, I think there can be a lot of niches built. Like one of the reasons, for example, we invested in Master Chow was in the Asian ready-to-cook or noodles category. There was only Ching's.
Right.
It's not like everyone loves Ching's, right? Like it's just you're buying that because that's the only category product available. So they say, let's say there's another brand. Like that, in every category, there is a possibility of expanding brands. That's going to be true for the next 10 years.
Right.
So we'll continue to do that.
Okay.
Brands are usually less risky, and the outcome is also not as large as a consumer tech outcome. So on the other hand, what we do is we back companies where it's pre-revenue, and for the unit economics to work, it might take a fairly long time. It's not like they're going to be profitable immediately, and therefore the risk is higher, but usually the reward is also much larger. So that's sort of our approach in terms of portfolio allocation. To your question on what I
Next
think
big
is the next big thing, I think I'm also hopeful about AI.
Right.
Not in the sense that we will build another OpenAI sort of competitor in India. Probably we will, probably we might not. But I think this might lead to a lot of existing industries doing things very, very differently. One is AI being incorporated, let's say, in a large enterprise, and they're using
So
it.
basically AI seeping into every corner
Single
of
one.
the
Yeah,
market.
that is one path.
Okay.
Where you can fund like software plus AI companies
Right.
which are selling to large enterprises. The other path is actually rethinking the economic models completely ground up.
Okay.
And you can start a newish sort of company in, let's say, journalism, for example. With AI, you probably don't need hundreds of employees. You can be a very, very small company and have outsized sort of impact. That is possible now.
So instead of just revolutionizing tech, it can
Yes,
it can
other
revolutionize every
industries.
single industry.
Exactly.
Right.
So that's what I'm hopeful about, and for that you don't necessarily need a strong moat, or you don't need to, and you won't compete with companies outside India.
Right.
Let's say someone is building a journalist sort of tech product or a news product for India. These are going to be built by sort of folks living in India, not necessarily someone in US.
Right.
So it gives you a right to win. So that's what I'm looking at, like in terms of how do you apply AI to existing industries and rethink the economic models.
Hopefully Pratilipi, one of your portfolio
Yes.
companies, does it.
Yeah, Prathalip has been doing that for quite some time, and now
Okay.
after launching AI, I think they're using it as
Okay.
well.
Alright. So my next question was, some of our aspiring entrepreneurs who's listening to this podcast, how do you go from a stranger to a partner? Like, what is the process? How do I approach you? How do I get funded? Things like that. Can you just take us through a very real life scenario?
Sure. See, we are open, like our emails are sort of out there. Having said that, we do get a lot of inbound sort of deals. So I think the way you craft the email to your pitch deck, we do look at all the decks that come our way.
Right.
But there's only few minutes that you can spend on every presentation. So therefore it has to stand out, and if it does, whether through the email or the way you're reaching out or through your traction, you have to figure out like what is it that makes you different. Is it the product? Is it the market you're going after, or is it the way of doing things which is different, or is it the traction? Sometimes very early on you get crazy traction, and that could be a selling point.
Right.
So you'll have to figure out what your selling point is and highlight that in the first sort of pitch that you do, and that gives you a meeting.
Okay.
So then, if we are impressed, and we will speak to you over phone, Zoom, whatever, and then there's usually a couple of more meetings which are in person, where we try to delve deeper into the product, deeper into the metrics, look at what the competitor sort of landscape is, and then we build a sort of internal investment thesis note. And this is for us to get convinced, and once we do write it out, we realize probably there are certain gaps
Right.
which we are not yet fully convinced on. Then we go back to the founder again, speak to them and try to address these points, and if we are able to address those points sort of convincingly enough, then we take it to our IC.
Okay.
And once we take it to the IC, then we get a yes or no sort of decision, and sort of the IC's inputs on why their views are either the same or not the same, like irrespective, we take their views, and then we sort of make the investment and issue a term sheet to the founder. And that's sort of the process.
So would you have any advice for, I mean, you see a lot of pitch decks, right?
Yeah.
So how can a founder make their pitch
Yeah,
deck sort of stand
especially
out?
because it's a fashion right now to become an entrepreneur.
Yeah.
Sure.
So everyone makes a B plan, puts some financials, and just probably sends a pitch deck to
So
you. And
what
you've
would-
probably
yeah.
seen that as well. You've
Yeah.
seen a lot of, just very plain
Glorified
pitch decks. Yeah.
also, yeah. So what would
So-
make it stand out from a very authentic point of view? Like you know it's real, it's not just glorified, but also you see potential in it.
Yeah, you see, if you do have a very, very different idea, it'll automatically stand out. And provided you do a decent job of building the deck and highlighting it, I think it'll stand out.
Okay.
But sometimes the let's say small case came to us on a pre-product stage when the product was not there,
Not
that I
ready
couldn't try out the product. Then it's harder, right? Like it's harder to explain a concept which doesn't exist yet.
Right.
As to why is it important, why would it work. Then the other path for reaching out to VCs would be to actually speaking to their existing portfolio founders and telling them that, because founders speak to founders more easily than
Right.
VCs. So you could reach out to some of our founders and then pitch them the idea. If they're impressed enough, they'll WhatsApp me saying this is a very interesting deck, you want to look at it. And if it comes to a founder, there is 75 or 80% chance that we will end up meeting the person.
Okay.
So that's the other route.
Very nice.
So now we spoke about it from an entrepreneur's point of view and from a VC point of view, but we want to bring it up to the investors now.
Sure.
So what kind of returns do they generally expect, and what if the fund takes a dip? Like, how does it work from an
And
investor's
who are your
POV?
investors, so generally?
Essentially.
What type of people are they?
Yeah.
Like, what background do they come from?
These are like high net worth individuals usually, could be having their own business,
Okay.
which is successful and they built it over a period of time, or it could be that they're a CXO in a sort of large company, and they made money through that, and they want to invest in alternate sort of asset classes apart from public markets.
Okay.
And this is usually something that comes up. And these are most of our capital is domestic capital.
Okay.
And then there is SIDBI and SRI and all, which are more institutional sort of fund of funds which invest in a lot of funds. That we do have that as well, but it's mostly through HNIs and CXOs.
So, what is the minimum investment in WE?
It's about 1 crore
Okay.
over a period of 4 years.
And what kind of returns are they expecting from?
So, see, ideally, what in the listed equity space, you get about 15%
Right.
on an average, right, over a period of 10 years. So, people expect at least 20% because this is an illiquid asset. You can't take out the money
Right.
over a 7 or 8 year period. And also, the risks are higher,
Right.
right? So, at least 20%, ideally 25 to 30%
Okay.
IRR.
So, how's from a qualitative angle, say an investment goes bad, what type of phone calls will you expect from your investors?
See, ideally, we don't get like panicked phone calls at all
Okay.
when things don't work out, because most of our LPs, like, or rather all of them, do understand that things will not work out. It's not that if we invest in 10 companies, 8 of them will succeed.
Right.
If we invest in 10 companies, 2 of them might succeed, and that's probably good enough to return the fund. So they do realize that. But yes, having said that, like let's say if you have multiple companies shutting down within 6 months period, you will get antsy that, you know, do you have winners or not? I think that's the more important question, not about why these companies are shutting down. Is like, fine, this has happened, but then what are your winners looking like and who are they?
So what does approaching these investors look like? Like, how do you get them on board, or how do you identify?
Or do they just come to you searching for an alternative?
Very rarely that happens. Yeah, they like a cold call. Like we have our Google sort of number, it's my number, which is listed there, and a couple of times I've got calls from family offices looking to, like you said, invest in the asset class. That's great. It's easy to convert when it's an inbound. But most of the time, like I mentioned about founders reaching out to us, is the same thing for us as well.
Okay, so
We can't do a cold hit. It has to go through like a referral of someone they know, and them talking about WH Ventures and saying you should look at this as a possible investment. And then we go and pitch, just like founders come and pitch to us.
So it's a very tight
circle network.
community.
Yeah.
Yes.
Alright, that was a nice answer. Sir, I would like to end it with this question.
Sure.
The VC career trajectory is a very steep slope, and it comes with a lot of delayed gratification.
Yeah.
How did you convince yourself to push through and you knew that in the end it'll be worth it? And for someone like us who want to get into this career, what do you think is the right path, and what is your advice for us?
Yeah, I mean, it's a good question. It's an interesting question. I don't know if the answer is that straightforward or not.
Right.
Because there's a lot of luck involved, right? It's not that, like I said, when I started my career, I knew I just wanted to be in investments. But 90% of the time I was thinking probably it might be in the listed space. And then I worked at Spark Capital, realized that this is probably not for me. It was getting too repetitive in terms of quarterly calls and results
Doing
and
the same
looking
thing
at
again.
companies.
Same
Some people
deal
enjoy
session
it because
calls.
it's easier.
Okay.
You can invest in companies on a click. You can exit companies at a click.
It's very monotonous.
It's easy, but you do make a lot of money as well. It's
Right.
easier to make money. But this is much harder, in my opinion. I
But
think
there's more money here.
not really.
Okay.
That's where I'm coming to. Like it's not that you will necessarily make a lot more money here than, let's say, being an investment banker or public markets or private equity, etc., or even a real estate fund. That's also an asset class, right? So it's harder for multiple things that we spoke about.
So, but VCs in general, the
The
common
returns.
perception is that there's a lot
Higher
of money,
Yeah.
super rich.
Yeah,
That
that's
is
the
how it
problem. Yeah, that's the problem. It's not true.
Okay.
I mean, there is a lot of money in the sense that your management fee 2%, that sometimes can give you larger
lot of
salaries,
money.
etc.
Right.
But it's not really a lot of money. You can get that salary working at a startup also,
Okay.
if you're good, or you can get it in public markets also at a mutual fund, etc. So salary per se doesn't give you wealth. I think wealth is created over carry
Right.
and getting it right. But like you said, it's incredibly delayed sort of gratification, meaning it takes 10 years.
So, what convinced you to just stay through it, sir? How did you convince yourself to do it?
See, I think it's good. So when I switched to sort of WH Ventures also,
That was around 7-8 years back.
8 years back, and at that time, I didn't know how long I'll be spending sort of in the VC space.
And that time the VC space was even more.
Obviously, very nascent, like
yeah.
2015, 2016. But I said, okay, let's give it a few years and see if you're good at it or not. What ended up happening, I think, if you look at the trajectories of most successful sort of venture investors who've stuck on, I think whether they're successful or not is secondary, but if they've stuck around as a career path, you'll see that early on they find some companies which ended up being winners.
Right.
That gives you the confidence that probably you're good at it. For me, it was small case.
Okay.
That was the second deal which we did from our fund. And soon enough, we got validation that within 6 months of us investing, Sequoia invested. And then they raised Amazon and all those sort of investors came in. And they were also performing really well. Driven by that, we got few other sort of good
Slides.
companies. Yeah. And so that's what motivated me to stick on like for a longer period of time.
Also, is it arguably more exciting to work in a venture fund because from like public equity side, like you said, just buy and sell. Here you get to interact with new ideas.
Yeah.
And you get to meet founders. So
That's true. Yeah, it is more exciting in that sense. But I think what's also harder, one is in terms of delayed gratification, in terms of money.
Right.
Which fine, let's say a lot of people can be okay with it. The second thing is actually to understand whether you're good at it or not.
Right. Okay.
Because even if something is exciting, if you're not good at it, it's better you realize it sooner than later.
Right.
The problem with venture is it's not sooner, it's most probably later.
Later.
Because it takes 3 years or 4 years for a company to shut down.
Right.
Only
Then
when,
you wasted that
yeah,
many
only when
years.
you spend those 3 years do you understand, are you able to pick companies the right way? Are you able to believe in founders in sort of their vision? And also, are you able to read people the way you're supposed to be reading people?
Right.
There are multiple ways you can get it wrong.
Right.
And if you do get it all right, then you figure out in the end of 3 years, 4 years that probably you're good at it. Then it's easier to convince yourself about the delayed gratification of money. But the harder part is actually to understand whether you're good at it or not. And there is no other way apart from spending few years at a fund. So someone who is interested in VC, they'll have to go with an open mind that probably this is for you, probably it's not for you. Like the same way I went into, let's say, public markets.
Right.
It's easier to cut your there. I quit within 18 months
Okay.
because I knew that okay, this is
Not
not for
it.
it. Let's try something else. So I think in the early stages of your career, let's say early 20s, I would say try out different things, and then you'll figure out something that you are good at and also you really like.
Okay.
Once you figured it out, it's easier to stick on.
So, but say I am interested in VC now, and what should I do? Like, how do I prepare myself to get to like a good GP stage later on? And then obviously I start out as an analyst.
Yes.
But what are those practices that I have to develop to get good at analyzing? So, like if you talk about public markets, sit in front of a screener daily and read markets, read news, all of that. How does it work in the VC industry?
See, VC industry, there are two things which is important early on. One is reading a lot in general, like just reading a lot of books and not necessarily related to investing, but a wider range of books
Understanding
related to
industries.
tech, could be related to anything else. Like, just going very, very deep within an industry and understanding how it works. That curiosity of reading, and it shouldn't be forced. It should be natural that you should like reading about different subjects and different sectors, because in your job also that's what you'll end up doing.
Right.
So that is one. And the second is actually be extroverted as a person, because you would need to meet a lot of people. And I think as an analyst or in the early stages, what you can do really well or what you can demonstrate to become successful is actually sourcing great deals. And to be able to source great deals, you can do it in front of a PC, but it doesn't give you an edge necessarily, because everyone can do the same thing that you're doing. What gives you an edge is actually your network
You have to be out
and
there.
the people. Be out there, like hustle like it's sort of nobody's business, and meet a lot more people, convince them to be top of their mind, to send you deals when they come across something interesting. That could be your friends, that could be people within the ecosystem, that could be anyone. Could be a college professor, for example. Good deals can come from anywhere. So it's about building that network. So if you can demonstrate and do that and read a lot, there are decent chances, and now there are a lot of funds that you can land a analyst sort of role.
Right.
And once you land that role, if you find 1-2 good companies, that sort of gives you a great trajectory to work on.
So then from an education perspective,
Yeah.
see, we're all doing our degrees right now, and then there's CA and CFA that you've done.
Yeah.
How do you think that has helped, or has it even helped anywhere in your VC career?
You don't know, right? Like when I studied, it was not that I was studying for venture, and I don't think anyone should do that, because like I said, there's 90% chance probably someone is not good at it.
Right.
So there's no point
Just
studying for
it.
that. It's not a very large role like that. So I think how it's helped is you understand numbers a lot better if given CFA, etc. And with CA you also understand how accounting works, right? Like, so that helps sort of probably not when you're making the investment decision,
But later.
but later on. When you're working with portfolio companies, sort of whether they're showing you the right things, whether they're looking the right things themselves or not. How do you manage cash flows? How do you get better when there is a crunch? When you can't raise a next round, how do you manage your finances better? All of that you can just read through a balance sheet very, very easily if you've studied. Because the base sort of education doesn't go away even if you don't use it immediately. But to answer your question, no, you can be
Just a
engineer
degree pass. Okay.
also.
So it's a very intuitive role. Right?
Yes,
Like
you
do
can
it,
be an
yeah.
engineer also. You can be a journalist. You can be a BCom, BBA sort of graduate, or you can be a
So
CA,
you just need to
CFA.
have a knack for
Exactly.
finding a good investment,
Yeah.
finding good
So
companies.
these are good professional skills to have.
Yeah, it's about understanding sectors and finding good companies, and also the other side is networking,
Right.
which is not necessarily connected to any education per se, right? Like
Be a social person in
Yeah.
Essentially.
be a social person.
Sir, so I mean, now that our last question's up, would you have any last piece of advice for our viewers before we wrap up?
Yeah, so I'm sure a lot of them would listening to this would be interested in like you
VC
said
space,
the
yeah.
VC space
I
and trying to
myself
get
am
to
interested.
yeah. So I would say just keep an open mind. It's not the beginning or the end of the world whether this works or not. Yes, this does seem very exciting from the outside, but
it's not
it's
really-
not very easy. It's easier to invest, but once you do invest, things will go wrong or things will go right, and it's a very, very long journey. So I think when you're very young, I wouldn't suggest that it's the ideal path to actually sign up to a very long journey when you're 21. You don't necessarily need to do that. So I think if you approach it, anyone sort of who's interested in it, if they approach it from an open mind saying, let me give it a shot. If it works,
happens,
it
it
works.
happens.
If it doesn't work, these are my ABC sort of plans, and I'll try give it a shot. I think that's easier way, and probably you'll end up being more successful that way.
Right.
Probably it's VC, probably it's not. So would be my.
I think that's a very important thing for us people our age, because
To
we're
just
so
try everything.
worried about what do we do.
Especially because we're from the Department of Professional Studies, we're always worried about academic achievements.
Yeah.
It's important that we keep our
Yeah.
minds open.
But yeah, and honestly, academics is one. But in the end, if you love what you're doing and you're actually working really hard at any workplace, you'll automatically rise up.
Right.
And you can switch jobs, you can switch industries. It's just more than academics, more than the scores. I think once you get a break, then it's about how you use that break, right? Like how
That
you-
busts a myth in finance also that's very immobile. Like there is room for mobility
Yes.
within like all
Yeah.
of them.
This is right. I mean, I'm an example. I've
Right.
moved across,
Right.
and now if I speak to my friends at Spark or Moody's, etc., we can't have a sort of straight conversation because I'm now in an incredibly different field
Right.
as to where they're at.
You can't relate to each other.
Yeah, it's very hard to make conversation, but it works, right? They enjoy what they're doing, and I enjoy what I'm doing. So that's all there is.
Alright.
So would
I
you
guess
like
that brings to the end of us to the episode. Thank you so much for joining, sir. We
Thanks.
had a lovely time. Learned a lot.
I hope
and I'm
our
sure our
viewers-
listeners learned a lot as well. So yeah.
Thank you, sir.
Thanks a lot for having me. This was fun. Thank you.
Thank you.